You're watching the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachardis. Thanks for joining us at XM.com. Global equity markets were a sea of green on Thursday after China indicated it won't retaliate immediately to the latest U.S. tariffs and that the planned trade talks could still go ahead in September. Investors took this as a signal that Beijing doesn't want the trade conflict to spiral out of control and escalate into an all-out economic war. The dollar outperformed most of its major peers as the calmer trade rhetoric saw market expectations for an aggressive half-point Fed rate cut next month completely evaporate. A quarter-point rate reduction is still fully priced in, though. Can this risk-on mood last? Admittedly, that may be difficult. China merely signaled that it's open to more talks, of which there have been several rounds so far, with little to show for it. In other words, negotiations do not mean progress, even if the two sides meet in September. Meanwhile, Washington will launch its next salvo of tariffs on Sunday, and the tensions in Hong Kong look to be intensifying, with Chinese state-run media increasingly not ruling out military intervention. Hence, this calm still looks like a temporary reprieve in a bigger trend of risk aversion. In Euroland, ECB policymakers Knot and Luttenschläger voiced opposition to a big stimulus package in September, both arguing against the central bank launching another round of quantitative easing. Interestingly, though, markets overlooked their remarks, with the euro moving lower instead of higher, most probably because both officials are well-known hawks. Today, the euro will probably take its cue from the latest euro area inflation figures due, as they could play a large role in determining the size and scope of any ECB stimulus. Besides the European inflation stats, we will also get inflation numbers from the US, as well as Canadian growth figures. This was today's Daily Market Comment. Thanks for watching at XM.com.